Hi, in December 2023 alone, the people of India invested more than 17,500 crores through SIPs. If I convert this into a dollar figure, it would be a more than $2 billion investment in the Indian capital markets just in a single month. And this amount is increasing at a rate of 25% per annum. And if the investment keeps on increasing at this rate, we are looking at a $5 billion investment per month in the coming 5 years. To give you an idea of how huge this amount is, Pakistan was recently given a loan of 3 billion US dollars to revive its entire economy. And the good part is, this amount is sustainable, domestic, and coming from all the parts of the country. But how was this made possible? How did a country which was once only left with a foreign exchange reserve of 1.1 billion US dollars now making more than $2 billion investment per month? And how is this helping India in fighting the foreign institutions which once used to rule the Indian capital markets? Hi, this is Mohit, and today we discuss the economics behind the $2 billion SIP of India.
The departure of the first contingent of British troops from the new Dominion of India was an
In
historic
1947, after the British left India, government didn't want India to be exploited by the foreigners again, and therefore foreign investments in India were very restricted. The average per capita income of the country was only rupees 249.6 per annum, and majority population of the country didn't even knew what is stock market. Also, the sources of capital with the general public were not sufficient to run big industries, and due to which all the major industries of the country such as mining infrastructure were operated by the government. However, to run its economy, India was heavily dependent on the oil imports from foreign nations. And for this, India needed foreign exchange reserves. But these reserves started depleting after India's biggest trading partner, the Soviet Union, started breaking down in the year 1985. Also, in the following years, there was a war in the Gulf countries.
The skies over Baghdad have been illuminated. We're seeing bright
Planes and missiles sent there.
Due to which oil prices started rising. As these countries were the primary suppliers of oil to India, India's already scarce forex reserves even depleted further to a point of mere 1.1 billion US dollars, which could only sustain 2 weeks of imports. India had no other option but to allow foreign investments in the country to increase the forex reserves. Investments up to 51% in the Indian companies were now allowed to the foreign investors. Foreign institutions and hedge funds saw this as an opportunity and made heavy investments in the Indian stock market. India's domestic sources of funds were no match for these big institutions and hedge funds. As a result, by the start of 2000s, Indian stock market was completely dominated by these foreign institutions. This made the Indian economy too much vulnerable to the global events. As a result, the Indian markets saw 4 major crashes in the first 8 years of the 2000s. Between 2000 and 2001, there was a dot-com crisis in the Western countries and the 9/11 attacks by the Taliban on America. As a result of which, there was heavy selling by the FIIs and the Sensex crashed from an high of 6,151 rupees to a low of 2,595 rupees. In May 2004, Sensex registered a record one-day fall of nearly 565 points due to the unexpected defeat of the National Democratic Alliance, following which a foreign institutional investor UBS heavily sold its position in the Indian market. The Sensex fell from an high of 6,249 to a low of 4,227 during this period. In 2006, the market crashed again due to heavy inflation faced by the global economy. Again, there was heavy selling by multiple foreign institutions, causing Sensex to fall almost 4,000 points in a matter of a single month. And in 2008, after the American bank Lehman Brothers collapsed, FIIs pulled their investments out of all emerging markets including India.
Lehman Brothers is going bankrupt, and financial markets from Asia to Europe are doing their utmost to prevent Monday from turning from dark to black,
Causing Sensex to fall from an high of over 20,000 in January to a low of below 9,000 in October. All of these events had two things in common. The first was these were triggered by heavy selling from the foreign institutions, and the second is India did not have enough sources of domestic funds to fight these people. The government needed a source of domestic funds which is sustainable and large enough to give a competition to these foreign institutions. And the solution to this was SIP, Systematic Investment Plan. In this plan, small amount of investments were made every month by retail investors in mutual funds, who would then invest this money in stock market on the behalf of investors. Although the first mutual fund of India was started in the year 1963 by the Unit Trust of India, it was not a very popular choice of investment in the country due to India's long-standing history of multiple scams and market crashes. After 2008, multiple advertisement campaigns were launched to increase the awareness about mutual funds. But these advertisements were not able to pull out the desired results. The main reasons being the investments being very skewed, with the top 10 cities contributing almost 80% of the total investments, and with Mumbai alone contributing more than 33% of the total investments, and the extra cost being incurred by the mutual funds in bringing out investments from Tier 2 and Tier 3 cities, accompanied with SEBI's strict expense ratio norms. However, the things started to take a turn for good in the year 2013. SEBI launched multiple reforms. An additional 2% expense ratio was provided to mutual fund distributors for distributing schemes in cities other than Tier 1 cities. Information sharing process was standardized, which made different mutual fund schemes comparable, and direct plans were introduced, where mutual funds could be directly purchased from mutual fund houses without paying any commission to the mutual fund distributors. Then came the year 2016. After the launch of Jio in December 2015, there was an internet revolution in the country. The cost of 1 GB data went down from Rs 250 per GB to an average cost of just Rs 10 to 20 rupees per GB. Internet was now accessible as well as affordable. This was a great boost in increasing the financial literacy of our country. The information and knowledge, which was once only accessible to the urban population of India, now started to reach the less urbanized regions as well. Those who had financial literacy started sharing their knowledge, and those who didn't started educating themselves. In the same year, SEBI also allowed investments through e-commerce platforms. Companies like Zerodha, Grow, and ET Money later gathered huge sums of money from retail investors due to their simple and user-friendly interface. In the coming year, Mutual Fund Sahi Hai campaign was also launched, which was also a huge success in pulling new investments in the market. Then came the year 2020. There was lockdown in the entire country and people had no other option but to sit at their homes. This is the point in time many people realized the importance of savings and investments. People utilized this time to increase their financial knowledge. They started looking out of the traditional sources of investments like gold, real estate, fixed deposits, and saving accounts. Now the common public started to understand the concepts like inflation adjusted returns and benefits of long-term investing in the stock market. Almost 11 million demat accounts were opened during that period, and people started to see stock market as a potential source of their income. This resulted in heavy investments in the Indian markets, with 2021 being one of the best years in terms of returns India has ever seen. And the good thing was that investment through cities other than the top 110 cities had increased the most, with more than 40% of all the new demat accounts being opened in the tier 2 cities of India. Since then, the growth of Indian stock market and mutual funds have been unstoppable. During the year 2022, over rupees 2 lakh crores worth of shares were sold by the FIIs, but it had almost no impact on the Indian markets due to the huge amount of domestic inflows. If I would have told this fact to someone in 2010, no one would have believed. In the last 3 years, SIP investments have raised from Rs 7,302 crores in November 2020 to 17,073 crores in November 2023, and currently standing at 17,610 crores as of December 2023. With all this, the growth of Indian stock market seems unstoppable. Looks like everybody who's going to invest is going to make money. Or is it so? Well, that could be a topic of discussion for another video.